Hey everyone, welcome back to the channel. If you're interested in investing or finance, today's video is a must-watch. We're diving into one of the most famous investing books of all time, The Intelligent Investor by Benjamin Graham. This book is a goldmine of wisdom and has shaped the minds of many successful investors, including Warren Buffett himself. I remember when I first started investing, I was all over the place. I was chasing hot stocks, trying to time the market, and basically just gambling with my money. But then I read The Intelligent Investor, and it completely changed my perspective. It taught me the importance of investing for the long term, focusing on fundamentals and managing risk. In today's video, I'm going to share with you the key takeaways from The Intelligent Investor and how you can apply them to your own investing strategy. Whether you're a beginner or a seasoned investor, these principles are timeless and can help you build wealth over the long run. Let's get into it. Alright, let's start with one of the central ideas of The Intelligent Investor, the difference between investing and speculation. This is something I'm super passionate about because I see so many people getting caught up in the hype and treating the stock market like a casino. Benjamin Graham teaches us that investing is about carefully analyzing companies, understanding their business models, looking at their financials, and making decisions based on fundamental value. It's about becoming a part owner of a business and participating in its long-term growth. It's not about getting rich quick, it's about building wealth steadily over time. Speculation, on the other hand, is more like gambling. It's buying stocks based on rumors, market hype, price movements, or someone else's hot stock tip without really understanding the underlying business. It's about trying to time the market perfectly and hoping for a quick profit. And let me tell you, trying to time the market is like trying to catch a falling knife. It's incredibly difficult and often ends badly. I've seen it time and time again, people getting caught up in the excitement of a bull market, only to lose everything when the tide turns. The key takeaway here is to be an investor, not a speculator. Always invest with a margin of safety, which we'll talk about in a bit, and don't gamble with your money. Be patient, stay rational, and aim for sustainable growth. Remember, slow and steady wins the race. You need to hear this if you're an investor. Next up is the concept of the margin of safety, probably the most famous principle in this book. It's one of the most important concepts in investing. No matter how good an investment looks, there's always uncertainty. Stocks can drop, markets can crash, and businesses can face challenges. Buy stocks at a price significantly lower than their intrinsic value. Think of it like buying a used car worth $10,000. There might be hidden problems. So, negotiate a lower price, say $8,000. That discount is your margin of safety. It protects you from losses if things don't go as planned. It's like building a cushion between you and potential losses. Chapter 3. Mr. Market, your irrational business partner. Now let's talk about Mr. Market. This is one of the coolest analogies in the book, and one that I use all the time when I'm thinking about the stock market. Graham describes the stock market as a character called Mr. Market. Imagine Mr. Market as this unpredictable guy who shows up at your door every single day, offering to buy or sell you stocks. Some days he's super optimistic and excited. He's offering high prices for your stocks, maybe even more than you think they're worth. Other days he's pessimistic and gloomy. He's offering low prices, maybe even less than you think they're worth. The key lesson here is to not let Mr. Market's mood swings dictate your decisions. Remember, Mr. Market is emotional, irrational, and easily influenced by fear and greed. He's like that friend who's always got a hot stock tip but doesn't really know what they're talking about. Just because the market is down and everyone is panicking doesn't mean you should sell your stocks for a loss. And just because the market is up and everyone is euphoric doesn't mean you should jump in blindly and buy stocks at inflated prices. The stock market is there to serve you, not the other way around. You get to decide when you want to buy or sell, and you don't have to listen to Mr. Market's emotional roller coaster. Instead of reacting to Mr. Market's mood swings, take advantage of them. When he's feeling pessimistic and offering low prices, that's your chance to buy great companies at a discount. And when he's overly optimistic and offering high prices, that might be your chance to sell if you think those prices are unrealistic. Remember, you have the power to ignore Mr. Market's noise and make rational decisions based on your own analysis and investment strategy. Chapter 4. The Power of Discipline. Staying calm when others panic. Now let's talk about one of the most underrated aspects of investing discipline. Graham really emphasizes the importance of being disciplined as an investor, and this is something that I've learned the hard way over the years. It's easy to get caught up in the excitement of a bull market when everyone's making money, and it seems like the good times will never end. It's also easy to get swept up in the fear of a bear market when everyone's selling and it feels like the world is ending. But successful investing is not about following the herd or reacting emotionally to market swings. It's about having the discipline to stick to your plan, even when it's tough, even when everyone else is doing the opposite. Think of it like this. You're trying to lose weight, so you set a plan for yourself. You're going to eat healthy, exercise regularly, and track your progress. But then your friends invite you out for pizza and ice cream. It's tempting to give in, right? But if you really want to reach your goals, you need to have the discipline to stick to your plan. Investing is the same way. You need to have the discipline to stick to your investment strategy, even when it's difficult, even when you're feeling emotional. That means not panic selling when the market drops and not chasing after hot stocks when the market's soaring. Discipline is about staying calm when everyone else is losing their minds, sticking to your long-term plan, and making rational decisions based on your analysis, not your emotions. Chapter 5. Risk versus reward. It's not about getting rich quick. Finally, let's talk about risk versus reward. This is a topic that's often misunderstood, especially in today's world of day trading and meme stocks. Graham's approach to investing is very different from the high-risk, high-reward mindset you see a lot these days. He believes that investors should focus on minimizing risk rather than chasing outsized returns. Now, this doesn't mean you won't make good returns by following Graham's principles. It just means you'll be more likely to protect your capital in the process and avoid those big, gut-wrenching losses that can set you back years. Think of it like this. You can choose to invest in a risky startup company that has the potential to 10 times your money, but also has a high chance of failing. Or, you can choose to invest in a well-established, profitable company that might only grow your money by 10% per year, but has a much lower chance of failing. Graham's philosophy is all about taking calculated risks and prioritizing the preservation of capital. He teaches us that it's better to earn consistent, steady returns over the long term than to try to hit home runs with every investment and risk losing everything. By following his advice, like diversifying your portfolio, investing in companies with a strong track record and solid fundamentals, and always maintaining a margin of safety, you increase your chances of earning consistent returns while avoiding catastrophic losses. Remember, investing is a marathon, not a sprint. It's not about getting rich quick. It's about building wealth gradually and steadily over time. And that requires a disciplined, patient approach that focuses on minimizing risk. Outro: The Intelligent Investor, your roadmap to financial success. So there you have it, the key takeaways from The Intelligent Investor. If you're serious about building wealth over the long term, this book should be on your must-read list. It's not just a book about investing, it's a book about thinking rationally, controlling your emotions, and making smart decisions with your money. To quickly recap, understand the difference between investing and speculation. Always invest with a margin of safety. Don't get swayed by Mr. Market's mood swings. Stay disciplined and stick to your strategy. And focus on minimizing risk rather than maximizing reward. If you found this breakdown helpful, hit that like button and let me know in the comments what your biggest takeaway was. And if you haven't already, consider subscribing to the channel for more finance and investing tips. Thanks for watching, and I'll see you in the next video.